Hello and welcome to our new investment strategy update. Stubbornly high inflation and unusually sharp monetary tightening are the main challenges for the global economy going into the second half of 2022. The Fed's job of bringing down excess demand without crushing growth is getting harder. Rising prices and inflation expectations mean the central banks must front-load its interest rate hikes. With the Fed committed to fighting inflation at any cost, can the US economy avoid a severe contraction? We think that a mild recession in 2023 is likely, with policy rates peaking at around 3.5% and unemployment above 4.5%. Europe's situation is very different. With activity still below its pre-pandemic trend, growth in the Eurozone is more at risk from the war in Ukraine. Inflation is more supply-driven due to food and energy price shocks. The ECB's rate hiking cycle should be shallower than the Fed's, with rates peaking at around 1.25% in early 2023. The ECB is also launching new tools to avoid fragmentation risks. Monetary tightening has also begun in Switzerland, where rates should turn positive this year. In China, a progressive reopening is on the way. Authorities are reinforcing their pro-growth policies to support a fragile recovery, and supply chain pressures are slowly easing. But a full reopening will not happen until this autumn. Uncertainties abound, and the world economy faces severe challenges. Over the coming months, monetary policies will start to take effect, lowering demand and slowing growth. As supply-demand imbalances improve, inflation should start slowing. This should allow central banks to become less aggressive, making some of the more extreme economic outcomes less likely. Now, let us hear from Stéphane how we are managing our clients' portfolios in such a complex environment.
Four powerful forces are reshaping the investment outlook. Monetary policy tightening, that Samy just discussed, war in Ukraine, disruptions in Chinese economic activity, and political and social instability. For market, this means more volatility ahead. We keep a balanced portfolio positioning and believe investors should seek quality assets that can provide solid cash flows and income. While maintaining a neutral weight in equities, we implement put spread strategies on US and European indices to partially shield our clients' stock exposures against further downsides. We have extended these hedges to keep asymmetric return profiles in more volatile markets. Within equities, we focus on value and quality stocks. In terms of sectors, we like energy, financials, industrial, materials, miners, as well as healthcare and utilities. We have also increased Chinese stocks at the expense of broader emerging markets, as the world's second largest economy progressively reopens. In fixed income, we are constructive on sovereign bonds and investment-grade credit, where default and liquidity risk are less of a concern. In currencies, the US dollar should remain strong as global financial conditions tighten. Conversely, we have reduced sterling exposures, given the UK's worsening balance of payments. Finally, we retain our overweight in a basket of diversified commodities, including industrial metals, energy, and gold, to protect our client portfolios against high inflation. To sum up, the investment landscape now looks very different from any time in the last 3 decades. Markets are pricing new risks. The consequences of today's geopolitical, economic, and social challenges will be felt for years. This requires a prudent portfolio positioning. But this is also the time to invest actively and seize tactical opportunities, especially in sustainability. As the fabric of our economies evolves, the energy transition is accelerating. Current volatility offers an opportunity to position portfolios to benefit from this transition in the years ahead. Thank you very much for watching.